Many traders don't make money because they put their stop at the wrong spot. The stop loss is placed at a random spot and it's placed way too tight. In this video, I'll show you my rules, the way I place my stop loss and that the trade got space to work. If you ever had that problem that you got wicked out and then the market moved in your direction, keep watching. I'll show you exactly why you got wicked out. In the previous episodes, we talked about break of structure, changing character, for value gaps, premium and discount, limit orders, and a lot of other rules. These things tell us where to enter a trade. But professional traders always think about one thing first, that's risk. And that means where the trade is no longer valid. Listen carefully. A stop loss is not just about protection. It defines when your idea of the markets is incorrect. If price reaches that level, your setup is no longer valid. So a stop loss must always be placed beyond the structure that defines the trade. The rule. Where do I put my stop loss now? I call it the break of structure or change of character rule. Because if that trade doesn't go correctly and we get stopped out, that means that the market actually changed character again in the opposite direction. So our entry was no longer valid. So our stop needs to be perfectly placed. That means my stop loss goes beyond the fair value gap and the Wick's fair value gap. That's not how I determine structure. I want to take it up to a higher time frame and we go watch where the higher time frame's break of structure was, because that is defining where the market is headed. We zoom into a 15 minutes to make sure that we actually find where it was for our entry. And we take that higher time frame Wick to make sure if the market goes beyond it, then we are no longer valid trading in the same structure. If price breaks beyond that point again, it means that the market is likely moving to somewhere else. And my trade or the idea after the trade is no longer valid, and that's okay. An example. Say that we have a bullish setup, we have a break of structure, afterwards we create a 15-minute fair value gap. That fair value gap lies in a discounted area. What is perfectly fine, so we put a limit order in that fair value gap. Now I look at the structure that is created to move. So zoom out, that means go in a higher time frame. The stop loss goes on the higher time frame structure, not inside the fair value gap, not at a randomly place, but beyond the 15 minutes volume. So this shows you exactly if the trade is valid, yes or no. Why a lot of traders don't put their stops at the right place? Because they want to have it too tight, because they want to have a huge amount of R collected. Sometimes they also put it inside the structure because they don't see the market structuration of movement. Or exactly at the obvious level where liquidity is, where actually people are, where the market is drawn to. Then the price taps the stop and moves exactly where they expected. This happens exactly because the stop was placed inside the structure. My rule prevents that because we watch the higher time frame structure and we trade inside the higher time frame structure. Risk consistency. Another advantage of my methods is consistency. Every trade follows the same logical principles. Your stop is always placed relative to that structure, not emotionally based, not R collected based, not based on guessing work, just logic following the same framework over and over again. Remember this one. A stop loss being hit is okay. That doesn't mean that every trade you will take the next time is not going to be correct. Not following the rules that you placed for yourself, that is something you should not be doing, because this will make you inconsistency. A professional trader accepts that not every trade is a winning trade. He simply makes sure that the not winning trades stay under control. So make sure that you keep to my rules that shown in a previous episode, how much you want to give in a day to the market. If you follow this framework, you'll be more profitable than you ever been before. Now let me take you to an example on real life. I go to the market like we see them every day, and this is actually a live example of how we should move. Now, I taught you guys already that we use the 4-hour and the hourly as our main structure. And we go inside that 4-hour to actually look where the market is headed. So when I go to the market, I don't watch too many days behind, I just watch it right now. So what did the market do? First of all, here we had a break of structure to the downside. Why this one? We made a break of structure and we had a retest on this one. We made a new break of structure and we never came back up. We just kept falling downwards. So we take our fib tool, we take it from the structure's high to that structure's low. Then we come zoom in and we go watch if we find a 15-minute per value gap that is valid. Now, if you do not find a 15-minute per value gap, that can happen. Where do you put your stop? If you're incorrect, this is your stop of that 4-hour structure's high. Where do you enter your trades? On a 15-minute per value gap, of course. If we do not find a 15-minute per value gap, you can zoom in one more time. I would go to a 5. Anything below that, I would not risk. Because it doesn't always occur. So we go to a 5-minute, and inside that structure, we actually find a 5-minute per value gap. It's above my 50 level. It's between my 0.62 and my 7.8 level. This was your entry on a 5-minute base. Could you have taken it a little bit lower? Of course, possible to. Where do you put your stop? Still at that 4-hour structure, because this is the high that should not get broken if we continue in the same direction. So we should have been shorting because the market is trending in a downward movement. We made a break of structure on that 5-minute per value gap instead of a 15 this time, because we did not have a 15. Otherwise, we take that 15 minutes. Where do we want to head it to? To the low of that structure. This was this low. The market should go to. We could make an easy 2.9 R collected from this one. You would say, okay, that's not that much, but did you see that the market also dropped 400 points? A 360 point move with an accuracy of very, very close. This is the framework I use every day. This is where you put your stop loss if you place it correctly. I also do one-on-one mentoring. If you really want to improve your skill and you still are not clear where to go put your stop loss, in the description you can find a link, or in the subtitles actually above, you can find two options. You can do my bootcamp, or you can get the mentoring from me one-on-one. Those spots are very limited, and I do not let anybody in. If you are able and want to improve your skills fast enough, I'm here to help, and I will hold your hand until you get profitable. I've done it with a lot of traders, and I'm here to help, and I just want to make sure that you actually get to that point where you want to get to. So remember, structure gives direction. For value gaps, give that entry. Premium and discounts give you the value where the market, where you should take a trade from. And that wick of that structure of the higher time frame defines where your maximum risk is to put it. On the next episode, I'll show you how I set my first take profit on using my method. See you in the next episode.